Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's edition, we're actually going to be talking about trading psychology. So, if you've been trading for any length of time, and pretty much you must have heard profitable traders, professional traders, telling you that psychology is actually, if you were to break down the three components that you need to become a consistently profitable trader, then you're going to discover that psychology is going to take a huge chunk of what you need to do in order to become a consistently profitable trader. Because, in fact, if we were to break it down, it's going to be something like you need 10% is going to be devoted to your trading strategy. That's a profitable trading strategy that is going to give you an edge over the markets. And 20% is going to be devoted to your risk management, because even if you're trading with the best trading strategy in the world, that's going to give you win rates upward of 90% or whatever. If you're not pairing that with a profitable risk management system, then you're going to struggle to become profitable. Because the math behind it is, for example, if you're trading with a trading system that has a 90% win rate, let's assume that every time you win a trade, you actually make $1 profit, okay? And every time you lose a trade, you actually lose $10. Now, in this case, if you were to take something like 100 trades, for example, then since you have a 90% win rate and every time you win, you actually make a profit of $1, then this is going to translate into 90%. That's 90% of 100, which is going to be the 90 trades you won, would give you a profit of $1 per trade. So 1 times 90 for the 90 trades you took is going to give you an average profit of like a gross profit, of $90. Okay. Well, the trades that you lost, each one you lost, you actually lost $10 on it. So since there are 10 losing trades in this example, then those 10 losing trades would have cost you a gross loss of about $10 per losing trade times 10 losing trades. So that's like $100. So in this case, when you subtract your gross loss, which in this case is $100 minus $100, and you subtract that from your gross profit, which is $90, you're still going to end up with a minus $10 loss on your account after taking 100 trades. And this is even though you have on paper, it's going to show that your trading strategy has a 90% win rate. So it doesn't matter what trading strategy you're using. If you're not pairing that with a proper risk management system, or you get emotional when you're trading. What I mean when I say you get emotional is, let's say you take a couple of trades and lo and behold, let's say you won one of those trades, you won the second one, but then the subsequent 4 or 5 trades that you took all ended up being losing trades. And so now you're kind of emotional, you're flustered, you want to make back all of the money that you lost from those losing trades. And so instead of sticking to the rules, sticking to our risk recommendations of not risking more than 1% of your trading account's capital per trade, you get emotional and you want to make back all of the profits that you just lost. Okay, so instead of continuing to risk 1% per trade after taking those 5 or 6 losing trades, you decide, you know what, I'm going to risk 5% so that if I just get one winning trade, I'm going to recover all of the losses that I had. Now, when traders start thinking like this, most of the times it's because they're revenge trading. Okay. They want to make back what they lost in a single trade, and they just want to get that pain of loss that they've encountered, that they felt, off of their chest. Okay. Now, in this case, you are actually doing something that is detrimental to you, because what if that trade that you took, let's say you're down like 4-5%, and now you're risking 5% on a single trade because you want to recover all of the losses that you had. And what if that trade ends up being a losing trade? And then the trade after that, now you're going to start getting scared. And so instead of even continuing to risk like maybe 1% of your account's capital, you're going to start getting scared, okay? Maybe if you're trading a prop firm challenge and you do that, you would have blown the account, okay? So in essence, I want you to know that the 3 components that you need to become a consistently profitable trader, the one out of those 3 components that holds the biggest significance is trading psychology, because 70% of what you need to become a consistently profitable trader is trading psychology. It's not most traders. In fact, I'm not even taking myself out of this. Most of us, when we get started, we always tend to think that if only we could get a trading strategy that wins like 90% of the time or whatever, that all of our problems would be solved. But that's actually far from the truth, because just like I gave you from the numbers here, you could have a trading system that wins 90% of the time, but if you don't couple that with proper risk management, you're still going to struggle to make money. And the only way you're going to follow your trading plan to the T without breaking it is if you have your psychology on pat, if you have your psychology in check. Okay, and that's why today's class we're going to be talking about trading psychology and how to handle losses. Because whatever they would want to tell you out there, most of those gurus and most of those fancy traders showing you stuff, trying to sell dreams to you, they might want to make you believe that losses are, you could just just walk your way around losses in trading. But let me tell you the hard cold truth. Whatever you do in trading, you cannot avoid losses. They are inevitable. If you don't have a crystal ball that's going to tell you what's going to happen in the future, then there's absolutely no way for you to know what the market is going to do. And so, since you don't know with absolute certainty what the market is going to do in the future, you are going to have to make up for that by managing your risk properly. Because, again, I keep giving you guys this example in the previous ITU Forex classes. If, for whatever reason, let's just hypothetically think that you have a way of knowing with 100% certainty exactly what's going to happen in the future at a certain point in time, for example. So let's say you happen to be in the trading industry, and let's say for the next 5 or 6 hours, you know that price is absolutely going to go down on this particular chart. This is the USD JPY chart. So you know without a shred of doubt that this 1 hour chart that you're seeing here, the next 6 candles are all going to be bearish candles. Now, when you know this information without a shred of doubt, and you happen to have a couple of thousands of dollars or hundreds of thousands of dollars lying in the trading account, what would you do with that information? Because the reason why I pose this question to you is because if, for example, if for whatever reason you happen to know that with 100% certainty that price is going to go down on this particular currency pair, then it would only make sense for you to risk maybe 100% of your trading account's capital, or maybe much more than that. Because since you have a crystal ball that is going to tell you exactly what's going to happen in the future, then you know for sure how many pips price is going to go up against your trade, or maybe even not even go against your trade at all. And so in that case, you might decide to risk exactly all of your account on that particular trading position, and then aim for, to the exact pip where you know that price is going to go before it reverses in the next 6 hours. And so in this case, if you know with 100% certainty that price is going to go down, and it's going to go down exactly where you're going to get in and where you're going to get out, then it would not make sense, or it would not be in your best interest to actually say, okay, I'm going to manage my risk, because by that time the risk is already off the table. The risk is off the table because you know with absolute certainty what is going to happen. And so you could decide to risk everything you have in your trading account. Heck, you could decide to sell your house, bet the farm on that particular trade, and in a couple of hours, that trade is going to hit your profit target, and you would be a millionaire or much more than that. But the truth is, we don't know. And anywhere there's uncertainty, then there's risk involved. Because if there's something that's uncertain, then you absolutely cannot do without managing your risk properly. And so since there's an element of not knowing in the future what is going to happen, then we need to make up for that by protecting ourselves against any adverse thing that is going to happen. So what that translates to in trading is, if, for example, you took a trade, and then based on your analysis, based on your backtesting, based on all of the experiences you've gathered from the market, from trading, with whatever method you're trading, you know that there's a high chance that based on what price is doing right now, there's a high chance that price could decide to go down. But then this is not 100% certain, because just like you're anticipating that price is going to go down, the market has a mind of its own. It might decide to say, you know what, I don't agree with you this time, and I'm going to do the opposite of what you think I'm going to do. So in that case, you want to position yourself in the way that if price was to do what you expected it to do, what you're actually hoping that it will do, in this case, then you're going to get a favorable outcome, which is going to be a profitable trade. But if price does not agree with what you're going to do, or the trade you placed, then in this case, you want to limit your losses because you don't want a single trade to define your trading career. If you place a single trade in this example, for example, you don't want it to be that if that trade was to go against you or hit your stop loss, then all of the money that you have as your trading capital, because in trading, if you don't have capital, you don't have anything to play with. You don't have skin in the game. You can't participate in the game. You can't make profits. You can't do anything. So you don't want to be in a situation where one single trade is going to decide whether or not you're going to decide the future of your trading career. Because if you are to risk your entire trading account's capital on a single trade, then if that trade was to hit your stop loss, you're out. You wouldn't have capital to trade with again. You'd have to go to, borrow money or sell you something, or you don't want to do that. And that's why we tend to manage losses, because losses are inevitable. In as much as we could spend the whole day analyzing the charts, analyzing, okay, this is what price is likely going to do based on what it's done in the past and all of that, that does not guarantee what price is going to do in the future. It doesn't. And since it doesn't guarantee it, we need to limit our losses so that it doesn't end our trading career. So that any loss we take is just, one of the losses that we take in business. In fact, I want you to have a mindset. I want you to have a mindset where your goal is not to take one trade and then, okay, I want that trade, if this trade doesn't hit my profit target, I'm done. Or if this trade hits my stop loss, my career is over. No. I want you to set a mindset where when you take trades, you're actually positioning yourself in such a way that even if you were to lose 100% of the trades that you take, you're still going to be in business as a trader. It's not going to end your trading career. Let me explain what I mean by this, okay? So let's assume, this is just for simplicity's sake, okay? So let's assume that you're trading an account, and the account that you're trading is actually a $100,000 account, okay? This is an example, okay? So your trading account's capital is $100,000. Let's say trading capital here. Okay. I can't spell today. So let's say trading capital. So let's say your capital is $100,000. But this capital is actually not your risk capital. What I mean by this is not your risk capital is in trading, in the financial world, there's something known as there's something that is referred to as risk capital. This is an amount of money or amount of anything you're trading with or investing with or whatever the case might be, which if you were to lose that money, it would not change your lifestyle. It would not mean the end of the world to you. It will not significantly, it's not even going to prevent you from sleeping. Okay? So when you're trading, apart from your trading capital, you also need to establish what your risk capital is. So for this particular example, we're going to assume that since you're trading a $100,000 account, your risk capital might be something like $10,000. So what I mean by your risk capital, just like I explained to you now, is the amount of money that even if you were to lose it, is not going to change your lifestyle. It's not going to drastically, it's not going to make you want to, off yourself or something like that, for lack of a better word. Okay? So in this case, if $10,000 is your risk capital, then you need to plan your trading, create a trading plan in such a way that the worst that is going to happen, the worst that could ever happen to you, is if you were to lose all of the trades you set a goal to take, then you should only lose your risk capital. So in this case, let's assume that you've backtested your trading strategy, because that's the responsible thing to do. So whatever method you're using to determine when to buy and when to sell and how much to buy and how much to sell, when to get in, when to get out, whatever the case might be, you've backtested it on historical data. You've proven to yourself that it's actually a proven trading method. You've taken hundreds of trades with it in the past, and it's proven to you that it's a profitable trading method. Okay? And let's say from the data that you were able to gather, you saw that this method actually has on average, okay, it has a win rate that is hovering around 40 to 50%. Okay? So let's just make it easy for the calculation. Let's just say it's a 40%, or let's say it's a 50% win rate trading strategy. Okay? So your win rate in this case, let's type your win rate, okay, is 50%. Now, there's something that we refer to in trading as the law of large numbers. What I mean by the law of large numbers is when you're taking a trade based on the trading strategy, Even though maybe when you backtested a trading strategy in the past, it might show on paper that the trading strategy averages a 50% win rate. This does not mean that when you take 10 trades, it's going to be exactly 5 losing trades and 5 winning trades because that trading strategy has a 50% win rate. That's not how trading works. Most times, you're going to have what is known as variance, okay? So you might take 10 trades, and it might so happen that, you know what, the market conditions was not favoring your trading strategy at that particular moment in time, and as such, the 10 trades that you took have a, let's say 40% or 30% win rate. So you ended up maybe losing 7 trades in a row, and you only won 30. Or maybe you had a sequence of win loss, win loss, win loss, win loss, and that's how it ended. At the end of the day, maybe you had 6 winning trades or 4 losing trades, or all of this. Anything can happen like this. The mindset I want you to have is that no matter which trading strategy you're using, you're not going to know the exact sequence of trades, the outcome of the trades you take, the exact sequence they're going to be. So just because I tell you that a trading strategy has a 50% win rate does not mean that every trade you take is going to be exactly 50%. Just like I told you, let's say you take 10 trades, it's not going to be exactly 5 winning trades and 5 losing trades. It might be more or less depending on how the market is reacting to your trading strategies, conditions that it was designed to favor. Now, with that out of the way, the only way you can be able to manage this properly is by looking at this from the perspective of the law of large numbers. The law of large numbers states that when you're trading a trading strategy or whatever the case might be, you need to understand that the edge of your trading strategy is only going to play out when you take a large number of trades. So just like I told you, when you take 10 trades, it's possible that you might have more than 5 losing trades or more than 5 winning trades or whatever the case might be, even if your trading strategy has a 50% win rate. But the more trades you take, the more the edge of your trading strategy is going to come close to 50-50. Let me use an example that is really going to drive this point home. So let's say you're flipping a coin. Now, before you flip this coin, assuming it's an unweighted coin, the probability that it's either going to land on heads or tails is 50-50. And since the probability is 50-50, you'd assume that since it's 50-50, if you were to flip this coin 10 times, it would land 5 times on heads and 5 times on tails. But that's not what happens. If you've done any experiment like this, you would have known that most times it's usually maybe going to land a little more heads, a little more tails in that 10 trade sample size. But the more flips you do, let's say you do 100 flips or 500 flips or 1,000 flips, it's going to approach that 50% probability more because you're taking more samples. Okay, so in this case, you need to understand that if you're trading with a trading strategy, you need to take a lot of trades. Assuming that trading strategy is even profitable to begin with, you need to take a lot of trades before the edge of that trading strategy is going to manifest itself. When we're talking about this from a trading standpoint, you need to understand that we talked about this, I think, in the last class or the last 2 classes back. A trading strategy, whenever you design a trading strategy, most of the times it's designed to exploit a certain tendency in the market. So when you're trading with a trading strategy that is a trend-following trading strategy, from the name, it gives it away that trading strategy was designed to exploit trending market conditions. So when the market is trending, that trading strategy is more often than not going to give you more winning trades or more profits from your winning trades. But when the market is ranging or consolidating, that trading strategy is going to struggle. Most of the times, that's when the trading strategy is usually going to go through a losing streak, or maybe, we are not even going to find much trade setups or whatever the case might be. Okay? So in this case, you need to understand that the more trades you take, the more that trading strategy is going to be exposed to most of these trading conditions. So when you take like 100 trades, then more often than not, there's going to be a high probability that those 100 trades would cover periods when the market is ranging, when the market is trending, when the market is consolidating, and all of this. And that's the reason why you need to take those much trades, because you might take, if you focus on taking only a little number of trades, like 10 trades, for example, those 10 trades might be taken when the market was ranging. And so it's not going to give you an accurate depiction of what is happening in the market. Now, with that out of the way, let's assume that now you understand how the law of large numbers works. Okay, and so you set a goal of taking 100 trades. That's your goal. Now, when your goal is to take 100 trades, for you to be able to properly handle the losses that might come with this, you need to understand that, okay, my risk capital is just $10,000, for example. And as a result of this, since when the worst of the worst happens, I don't want to lose more than $10,000, I need to work out my risk per trade in such a way that I'm only going to lose this $10,000 when all of the 100 trades I take end up to be losing trades. And so the only way this is going to work out is when you use this number to calculate your risk per trade. Okay? So your risk per trade in this case is going to be your risk capital divided by your goal, the number of trades you want to take. So in this case, it's going to be this zero is going to cancel this zero. This one is going to cancel this one. And so your risk per trade is going to be $100 for this particular account. Okay? For every trade you take, if you want it to be in such a way that you're not going to lose this account, then you cannot trade with a risk more than $100 in this case. Now, why is this so significant? The reason why this is significant is because when you're risking only $100 per trade, and it so happens that the market is completely against your trading strategy, it's going to be very difficult. But let's just for example, let's entertain the idea that it so happens that the market is just completely against you and all of the trades you took turned out to be losing trades. Now, you're only going to risk your risk capital. And that risk capital, before you even set the risk capital, is an amount that you're even comfortable to lose. So when you lose that, it's not going to affect your life, your lifestyle, or change anything significant in your life, because that's what you've already made your mind up to lose. But trust me, just like you're not going to find a trading strategy that is going to give you 100 consecutive winning trades, it's going to be very difficult for you to have a trading strategy that is going to give you 100 consecutive losing trades. So it's going to be next to impossible for you to blow your risk capital by trading like this. And why is this important? This is important because this helps you to properly manage your losses. If you know that you've already worked out your risk per trade and everything and all of these numbers, and you have a goal of the trades you want to take and all of this, and then you so happen that you find a trade setup from your trading strategy and you take the first trade and it turns out to be a losing trade. You take the second trade, the same thing, it turns out to be a losing trade. If you keep doing this and the next 10 trades you take all turned out to be losing trades, will that begin to scare you? Obviously, it wouldn't, because you've already conditioned your mind even before placing your first trade. You've already worked out your numbers and you're completely comfortable with losing not just 10 trades, not just 20 or 30 trades, but 100 trades if it so happens, okay? Because you've already worked out your numbers. But what if this was the other side of the equation? What I mean is, what if you didn't do this at all, and what you did was you just funded your account with your life savings, which is, let's say in this example, $100,000. And this particular $100,000 that you funded your account with, you cannot, and I say this with a capital NOT, you cannot, absolutely not afford to lose this money, no matter what the case might be. In fact, forget about losing the money. You cannot even begin to think of what would happen if you were to lose half of this money. And so, because of this, let's say you place your first trade and you were risking 1% of your trading account's capital per trade and you lost it. Place your second trade, you lost it. Let's repeat the same scenario that happened with the person who did the proper working out of the numbers, doing the risk per trade, doing all of the risk capital and all of those things. Let's say you also get 10 losing trades in a row. But in this case, you were risking 1%, 1%, 1%, and now you're down 10%. Okay? Just like him. But he has done the numbers, and so he's down not 10%, maybe at most just 1%, which is within his risk capital. In this case, you that is down 10% now, you're already starting to think, okay, wait, I just lost like 10% of my account, and I can't even afford to think about what's going to happen next. So I no longer want to do this. I just want to place one trade and make up for all of the money that I've lost and all of this. And let's say in this case, you just want one trade that is going to recover all of the profits from all of the capital that you just lost. And so let's say, for example, you were down 10% and now you're risking 10% so that this one trade If it just hits your profit target, you're going to make back what you lost and maybe an extra amount of profit. And so you do this. But let's say trade number 11, that you're risking 10% of your account's capital, trying to make back all of that you lost. You also lost that trade. Now, instead of being down 10%, you're down 20%. Most of the times, if it's money that you cannot afford to lose, you're already beginning to panic. You're beginning to, despair. You're beginning to think, okay, how am I going to make this back? All of your risk management and your trading plan and your psychology, everything is going to go out the window. And now you're not even thinking about managing losses or following your trading plan or following the rules of your trading strategy. You're just all out in a revenge mode trying to make back what you lost. And that's not how you want to trade. For you to trade like a professional, you need to accept that since there's uncertainty in the market, there's absolutely no way you're going to know 100% what is going to happen in the future. And because of this, you need to practice properly. You need to create a trading plan in such a way that even if the worst of the worst was to happen, which is probably not going to happen, because if you're trading this way with proper trading plans ahead of time, creating this for eventualities, you're usually not going to have 100 losing trades in a row. And so you're not going to blow your risk capital. Okay, but even if it was to happen, you're already very comfortable losing that risk capital because it's a number that you're okay losing. You've already done the work before creating these numbers. Okay, and so this is what you need to do. Take a pen and paper, write out the number that you're going to be trading with. If you're not trading on a live account because you don't have the capital to trade right now, or you're just, putting the finishing touches to your trading strategy, you're in the demo trading phase, you're in the phases where you've already finished your back test, now you're testing it live in the market, then that's okay. You just need to do this, come up with the capital that you're trading with, come up with the risk capital. Okay, that you can afford, that you are willing to lose for however many trades you're willing to take. Then from your back test, you're going to get the win rate of your trading strategy. You're going to get its average risk to reward ratio, all of those other numbers. Okay, but then work out the goal of taking 100 trades. Remember the law of large numbers. Even if your trading strategy has a 50% win rate, that does not mean that if you take 2 trades, you're definitely going to win 1 and lose 1. No. It doesn't work like that, okay? Just like you can have a 50% probability of flipping a coin and it's landing on head or tail, but if you flip that coin twice, it could land on head twice or tail twice. That's the same thing here. So you need to work out this and understand that the only way that your edge is going to manifest itself is when you take a large number of trades. The more the merrier. So if you want to take 30 trades to test it out, 100 trades to test it out, whatever the case might be, just make sure it's a large number of trades and then define your risk per trade and start trading. When you do this exercise, trust me, you're not going to be fearing losses at all, because even if the worst of the worst was to happen, in fact, you're already prepared for it. And that's how to trade. Okay? So with this out of the way, this pretty much brings us to the end of this week's edition of the ITU Forex class. And please, I want you guys to take this lesson, take the time to craft your trading plan, whether you're trading on a demo account or a simulation account or whatever the case might be. You need to do this. You need to do this. Because if you don't, you're always going to be scared when you're trading. You're going to be scared of placing a trade and having that trade hit your stop loss. You're going to be scared of losing a trade. You're going to be scared of many, many things in the market. This is all based on your trading psychology, okay? So you need to do this so that you're going to be, the market is not out to harm you. And you need to interact with it in this type of manner, okay? So once again, this pretty much brings us to the end of this week's edition of the ITU Forex class. And before we wrap up, I would like to use this opportunity to let you guys know about the other portion of the bots that we have, which are designed to help you earn while you're learning, while they trade on your behalf, do the risk management on your behalf, identify the low risk, high probability trading opportunities on your behalf. So you can decide to have a portion of your trading portfolio dedicated to them, and while you learn how to trade for yourself also. Okay, so if you're interested in it, please leave a comment in the comment section and let us know, and we'll be more than happy to assist you, set everything step by step, okay? Or reach out to us on the socials. Once again, I look forward to seeing you guys in next week's edition of the ITU Forex class. Have a wonderful rest of your day, and God bless you. Cheers.